Hi everyone, welcome to BBD show. Today we have an amazing guest, Stephen Perrenod, who we have talked to before, and today is going to talk about the Kelly Criterion, which is a way to optimize a portfolio. And then we're going to look at how one can construct a portfolio of Bitcoin and other assets. Many people hold Bitcoin and other things, so this method allows them to figure out how to think about the multiple assets, how to build a portfolio that's optimal, how to rebalance, and so on. And particularly, we'll look at Bitcoin and MicroStrategy if someone wants to benefit from the price appreciation of both assets. The best way for that is to construct a carefully managed portfolio optimized by well-tested math rules, which is Kelly Criterion one example of. Hi, Stephen. How are you?
Great. Good to be here, Sina.
Yeah. So, if you don't mind, introduce yourself a little bit for those who might have joined us lately. And you have an amazing, very impressive background. And then we will get into the concept of Kelly and what it is actually.
Sure. My background is originally in astrophysics, and after a few years in academia, I entered the supercomputing field, high performance computing field, and I was in that for several decades. And I continue to keep my toe in with some consulting work with some of my former colleagues who are otherwise based in the US in Silicon Valley. I'm in Asia. And we look at areas ranging from quantum computing and AI and traditional data centers and so forth. But I've been interested in Bitcoin for 10 years now and have been writing about it quite a lot. And you can find me on Twitter under Money or Debt. So for the Kelly criteria, what we have is a mathematical technique that is essentially model free. It looks like at a series of returns, and it makes decisions based on that history. You will know that Sina and I are both proponents of power law models for Bitcoin's long-term behavior. And we'll really only talk about that in passing. But the price history in terms of both the power law history and the volatility do get reflected in the parameters that go into the Kelly criteria. And that's true whether you evaluate it against the US dollar or T-bills or against gold or against Nvidia stock and other technology stocks, or MicroStrategy is a little bit different case because MicroStrategy also adheres to a power law that's even steeper. But we're going to look at Kelly criteria for all of those cases.
Awesome. So, a regular way someone might think of portfolio optimization is just figure out some percentage that maybe comes from intuition. Let's say I like MicroStrategy and Bitcoin together, and then I'll say, okay, 10% MicroStrategy, 10% Bitcoin, and then I'll just keep those percentages. If any of the investment goes much higher or much lower, I'll sell and rebalance quarterly or in any different period. How is Kelly different from other ways of portfolio construction? What is its main value and uniqueness?
Well, what Kelly does is it looks to optimize the growth of the logarithm of your wealth. And that turns out to be a useful utility function because it sort of offsets the fact that if you lose a certain percentage, then you have to grow by an even greater percentage to recover. As you know, if you lose 20%, you've got to grow by 25% just to be even. You haven't made any money, you've lost, the T-bill rate during that interval and so forth. So maximizing log wealth has been proven, with some fairly advanced mathematic techniques to be a very good method. Now, you don't necessarily see it a lot. You see Sharpe criteria, for example, promulgated a lot. And you see efficient frontier calculations where you have a mix of a lot of assets in a portfolio. You can do those with Kelly criteria, and there's even a form of the formula that looks somewhat like that. But what we're going to focus on today is the most basic form of the Kelly criteria, where you just look at two assets and compare those two assets and see what the appropriate mix would be, just between Bitcoin and cash, or Bitcoin and T-bills, for example, or going to the other end of things, between MicroStrategy and Bitcoin.
Okay, so perfect. All right, so if you want to dive deeper, let's take a look at what it does. I'll only say that maximizing log of sales, log of wealth, has this very interesting property of giving you some more protection. Essentially, it understands that losses are more painful than gains, so it's part of also like a huge subsection of economics that realizes it's a little bit better to protect yourself against loss versus position yourself against gain. So you gotta just give them different weights. When you have a lot more wealth, a few extra dollars doesn't really matter as much as when you don't have. So Kelly Criterion uses log wealth to bend the curve in a way that it weights losses a little bit more strongly than gains. Okay, I see your screen share. Let me know when you want it to be visible.
Okay, I think we can go.
All right, perfect. Bitcoin portfolio optimization. Yes.
Yeah, okay, great. So actually, a lot of this is relatively simple. So the quote from Feynman is relevant for that. So let's look at our agenda. First, what is the Kelly criteria? And then we're going to apply it. I've done the work to apply it separately to Bitcoin and US dollar, to Bitcoin and gold, Bitcoin and Nvidia, and Bitcoin and MicroStrategy. We'll save the thing that people are probably most interested in for last, so they'll hang around. And one of the things that you're going to see is very important is, what is your time frame? You really have to decide ahead of time, what time frame will you use to make these comparisons, because essentially, as you can see from the die in the upper right, that you've got a series of bets. And so each bet is a time window, and that time window could be anything from daily to monthly or yearly, depending on what your context is. So what is the criteria? It dates from 1956 from John Kelly at Bell Labs. And he did work on information criteria that was inspired by Claude Shannon's work on entropy of information at Bell Labs, and it's very important for communication channels. And there's the equation for entropy of information, which has a probability and a log in it. But basically, you can optimize the log of wealth, and it works because it allows you to take into account the compounding, but also the effect of pullbacks, and it avoids ruin. The idea is that at some point you're going to have a lot of losses back to back, and you want to avoid ruin. And so it's doing a balance between maximizing your wealth curve but avoiding complete ruin.
Okay, so let's unpack the formula and see what's in it one by one.
Right. Okay, so we're using the gambler's formula. There are variants, but this is the simplest way of looking at it. And that formula has an F as a fraction of your portfolio that you would allocate to an asset. And this is for a 2-asset portfolio. And so you make an assumption that one is your base, the thing you're denominating in, and that's going to be your less volatile asset. And the other is you're measuring against your base. So if you have Bitcoin and the dollar, there's less fluctuation of the dollar, you're using that as a reference. So then you're going to try to determine what fraction F of the portfolio would you put into Bitcoin. So now there are two key numbers. One is your win rate. For each time interval, what percentage of the time does Bitcoin outperform? And if it's just the dollar, then it's just up or down. But if you look at T-bills, then it would have to, exceed the T-bill rate of 4 or 5%.
So what do you mean by percentage of time? So is it like you initially say that my evaluation time windows are maybe monthly, and then I'll just look at history and see in which months Bitcoin has gone up versus the dollar, and then in what months not, and that balance will give me the ratio? Is that?
That's correct. We have 190 months since Bitcoin was founded. And it took a little while to get price discovery. So let's say we've got, 175 months or so. And if you compare to the dollar, some percentage of the time, somewhat greater than 50% of the time, it went up. And then Q is just the loss rate, the frequency of loss. How many months did it go down in percentage terms? So it's just 1 minus P. Mm-hmm. So one key parameter is P, but the second key parameter is B. And B is the ratio of the average win size to the average loss size. So on balance, when Bitcoin had a winning month, it went up more than it lost. And there's some ratio there. And that ratio, combined with how often you win, collectively enters into this formula. And it's simple. It's just the percentage of wins minus the percentage of losses, but decreased to the extent that the average win size is larger than the average loss size. I'll show you a couple of simple examples on a future slide. So you have a time window, you have a series, and you have to have enough, to have decent statistics. And then the other key assumption is that you're going to rebalance at each time window. So you have to choose up front what that time window is. So next slide, why does it work? And we've got a slide that shows you a little bit of the math of how they prove that you maximize log wealth with this formula. But the second bullet, you've got two sources for your edge. One is when P is greater than 1/2, and the other is when B is greater than 1. And B, remember, is the average win size divided by the average loss size. So let's take a simple case of a perfect die, and let's define a game where you roll the single die once and you win if an even number comes up and you lose if an odd number comes up. So what's the win rate? It's 50%, right? Mm-hmm. But the average win size is larger than the average loss size because the odd numbers add up to just 9 and the even numbers add up to 12. So the average win size is 4 over a long series of rolls. The average loss size is 3, and therefore your upside edge is B equal to the 4/3.
Now, quick question. Does it matter to go into, like when you're measuring the average win size of Bitcoin, does it matter to use dollars versus percentage?
You can do it. Normally you do this in percentage terms. You can also do it in the change of the log to the delta log. And you get quite similar results. And what I'm going to show you is all based in percentage terms.
Okay. So you look at average percentage growth of Bitcoin over your time window divided by average loss in the periods where Bitcoin was down. Okay.
Correct. So with this particular case, we would calculate the optimal fraction would be 1/2 minus 1/2 because P and Q are equal. The percentage of wins or loss, but the wins are worth more. So you divide the second term by 4/3, And then the answer becomes 0.5 minus 0.375, which is 0.125. So in this case, if you were playing this game, for each roll of the die, you would want to bet 1/8 of your portfolio. So if you have a bunch of wins, your portfolio grows, you're going to be betting a larger amount. If you have a series of losses, your portfolio is shrinking. If you lost 3 in a row, instead of $100, you'd be down to $62.50, right? Because you bet, well, okay, it wouldn't be that exactly that, because you'd be lowering it each time, but you would lower it by 1/8 each time, so it'd be a little bit higher. So in other words, the first roll you'd lose $12.50, but the next roll your portfolio would be 87.5. You bet 1/8 of that, which is $11, right? You lose again, you lose $11. And so by adjusting your portfolio each time, you're going to lose less in subsequent chances.
So let me think about the logic here.
Yes.
Someone might say, okay, this is a, what was it, 50-50? Are we assuming 50-50 chance? Yes.
Yes.
Of win and loss. And wins are bigger. Okay, so this is a likely positive investment on average, or bet. Then someone might say, okay, why don't I go 100% on this? Because on average, I'm going to win. Well, Kelly would tell you that, when you win, yeah, it's awesome if you go 100%. But if you don't win, if one of those cases happen that you lose, then you're done. So nothing really matters. Everything's gone, right?
Right. Right. And if you bet half, you'd be down to 50. And then if you bet half again, you'd be down to 25, right? Even if you adjusted, right?
Yeah.
So you lose the ability to maximize log wealth quite quickly, because now you're down by a factor of 4 after 2 months or 2 rolls of the die. Right.
Exactly. So
Okay.
it's a smart protection against losses.
And in the last bullet line, we've loaded the die such that we've got P, giving us an advantage as well. It's 0.6. So now we've got an advantage in both sides, both the percentage of wins and the amount of wins relative to losses. And so F increases from 0.125 to, in this case, to 0.3. So it's a combination of the two. This is part of the derivation. There's many papers written on this. There's a whole book, very thick book, with several chapters by Kelly himself and Thorpe, who's one of the other key researchers in the field. And this basically shows, you make a bet, what happens to your wealth? Well, you're going to bet F%. And if you win, it's going to go up by BF. But if you lose, it's going to go down by minus F. B's greater than 1, right? Because you're looking for positive sum games. And then what you do is you take the log of how that grows, and then you differentiate that. And the result of that is the equation we just showed you, which is the simple Kelly criterion. So the next slide is Kelly criteria applied to annual Bitcoin data relative to the US dollar. You only have 14 data points. This is starting from 2011. It turns out that, as we know, 3 out of 4 years, Bitcoin goes up, right?
Mm-hmm.
So P is 0.75. So now it depends on the next term. So the next term is going to be 0.25 divided by B. But B is the average win to loss ratio. And the win to loss ratio for Bitcoin initially was huge. It started out around 40. And if you take because it's fallen so much, what I've done here is I've taken a look back. Well, this is actually has every win-loss ratio in it. So it dropped from about 40 down to 12. It's still very, very large over the 14-year history. So if you
So
take
where does it end? What is your so 12 is for what period? Is it?
No, it's the most recent one. So it's taking over the whole history.
So the most recent average or most recent year?
It's the average.
Oh, okay. So it's just the whole history gives you 12%.
It's not 12%, it's the ratio.
12 times. Yeah,
It's
okay,
12
yeah.
to 1 ratio.
12 times, yeah.
Yeah, it's incredible, right? But
Amazing.
we know this, right? So you have this formula, 0.75 minus 0.25 B divided by B, divide by B, it's a big number, right? So that term almost goes away because B is so large. So you end up, if you do annual rebalancing, you end up with an allocation that's just a little under 75%. It's about 73% over this history. Now, you might say, gosh, I know it's never going to be above 50 again, right? We know it's been coming down steadily.
At this point, I think in the last couple of years, the curvature of growth would imply 45% annual, and maybe next year slightly lower. But this is all on average. Of course, there is bubbles as well.
Yeah, it's not the annual though; it's the size of the drawdown, right? So it's the skew. It's the combination of the power law trend plus the skew, right? But even if you just did say, well, you know, I'll throw away the first years because they were so large. I don't really have a lot of faith in those. If I just take a 5-year look back, then I'm still going to be around 70%. But the key here is you have to rebalance with an annual window. You can't be jumping around all the time. If you do that, you can have a higher allocation, right? The volatility is working for you. Now, this is the one slide.
I think the intuition there is if you do more balancing, more rebalancing, when Bitcoin is quote unquote overvalued, and you buy more when it's undervalued, just the frequency of that allows you to grow your wealth a little bit better. Do I understand it correctly?
Yeah, you're doing dollar cost averaging. It's forcing you to do dollar cost averaging.
Okay.
The next slide is really the one that it's not explicitly saying
so
Bitcoin's
let me stop here. Let me stop.
Yes.
Because just if you go back to the previous slide, I just wanted to also confirm this. How do you factor in the idea that the win-loss ratio might be going down? Although we know growth is going down, but at the same time, the drawdowns are also getting less pronounced. So it might actually be that you don't get a significant change in the win-loss ratio, but we definitely know that moving forward, it's going to be less than what it was. So is it, can we say that like historical data matters less now and more recent value should be considered?
Yes, I mean, that's what I do for myself is that, you know, I don't quite trust, right, that we'll ever get a repeat of the very early stuff. But if you just take a 5-year look back from where we are now in 2024, so you're including a partial year and the 4 prior years, you get a Kelly fraction F of 0.7 instead of 0.75. So it's still very good.
And the chart, the top chart you have, what is it saying? What is it that is changing? Are you just including more and more history that causes Kelly to go down?
That's correct. I'm adding each year in. So for the first couple of years, you'd be at 100% because you didn't have a loss year.
Okay.
And then you have loss years in 2014, 2018, 2022, right? And so they pull the Kelly down, but then it climbs back up, but it doesn't climb back up as high. And it gets pulled down again, and it climbs back up, still not quite as high, falls down again. So basically, if you were living through all this, you would have, suppose you got in 2014, you would have allocated 70%. In 2015, you look back and you say, wow, I grew a lot. Now I'm actually at 88% of my portfolio, and the Kelly fraction says should be at 80%, so I'll cut back a little bit, right? And 2016, it goes up some more, so now your portfolio is still above 80%. But then once you take a hit again, then you say, oh, yeah, I need to lower.
Yeah, so basically the lesson here is if you caught the first 10 years of Bitcoin history, it still doesn't really change your decision except for a few percentages. So looks like this is actually very robust.
That's right.
Awesome. Okay.
But it is a little bit jagged there when you have your down years, right? So you'd have to live through those, but we know how to do that. And this is just showing, indeed, returns and volatility have been coming down quite considerably, right? This is just the average month growth rate is the orange line. Average percentage was 30% in Epoch 1 and is now more like 7% in the prior epoch. And then the standard deviations have come down as well, too. So that gives you some pause about using the whole history. Now let's look at what happens if you use shorter time windows. So this is using 10 years of weekly data, and it's very, very noisy. So what I've done is I've filtered it by using 4-year sliding windows within the decade.
Mm-hmm.
And what you find is that early on, you might allocate up to around 25%, but over time it has come down somewhat. So today, with a 4-year window and with weekly data, you would allocate 18% of a 2-asset Bitcoin and cash portfolio to Bitcoin. That's a trader's portfolio, right? That's not a saver's or investor's portfolio.
Now, this is, so the reason Bitcoin is so much lower now is because you are doing a lot of rebalancing, and hopefully that you're hoping that all those rebalancing allows you to accumulate more. Now, have you looked at whether weekly or yearly or monthly leads to a better total wealth, or does it? How would you think about it?
Indeed, it does, because the shorter your window, the less you can hold. So I'm going to show you 2 other time intervals, and you'll see that for the longer time intervals, the fraction you can allocate goes up. So the key lesson here is that the more chill you are, the more Bitcoin you should hold as a percentage of your wealth or liquid capital. So we've got 2 cases so far. I'm going to show you 2 more that are intermediate. We're saying 18% if you're going to rebalance weekly, and we're saying about 70% if you're going to rebalance annually. So the intermediate cases are shown here on this next slide. It's the 4 weekly case and the quarterly case. And the orange line for each of those shows the Kelly fraction. And it turns out that the current best value for the 4-weekly case is 29%. And for the quarterly case is 40%. But I've also plotted the edge and the percentage of wins so you can see what those are like. And the percentage of wins is a little bit above 50%, whether you're in the monthly or the quarterly case. But the edge is different. So the edges are like 1.5 to 1 if you're using a monthly window or a 4-weekly window. But the edges are more like 3 to 1 if you're using a quarterly window. So the noise kind of gets smoothed out, right? And you see more signal in the win to loss ratio if you have a longer time frame.
Very good. So longer time frame, longer holding leads to more chances of success. The ratio of wins just goes higher than losses. Yeah, very interesting.
Yeah, and we kind of all know this. People who've lived through a full cycle, right, know that you should really be thinking about 4-year holding periods or longer.
Exactly. So, let me just try to see if any punchline we can draw from here. So for weekly, you got. Let me remove our own. Okay. So for weekly, 17%, monthly, 30%, quarterly, 40%, and the annual was 75.
70 to up to 75% if you
Up
use the
to
whole
70.
series, or 70% if you use the last 5 years.
Okay. Now, could one simulate all these and see which one gets to the maximum in some period of time? Because this is just a percentage, right? You don't know if still weekly is better than monthly or for total wealth.
I have wealth curves in the appendix, and maybe we'll get to those. Yeah.
Awesome. Okay.
So I've done that. But let's talk about the other assets, and then we can, with time, go look at some wealth curves. So this works with Bitcoin and gold, and right now we're a little over 1 kilogram of gold. Bitcoin, it's about 35 ounces, and it actually grows as a power law, just as Bitcoin versus the dollar does. The power law is about 5.4. It's not quite as steep. You measure it, from the same point of time, which is when Bitcoin began at the Genesis block. If you do annual rebalancing since 2011, the assumption is that gold is your denominator, right? It's the thing that's less volatile. And so you're traditionally a gold investor, and you're saying, gosh, maybe I should add some Bitcoin. How much should I add? Well, it turns out the answer is 77%. And if you use just the past 5 years, it's still 73%. And the reason is that if you take the 14 years, the win probability for Bitcoin against gold is 78%. And the ratio is a factor of 15. And if you restrict yourself to the past 5 years, the win ratio is still high. It's still over 80% in terms of percentage of time that you win for each annual interval. But the win to loss ratio is much smaller. It's a factor of 1.65. But that still gives you quite a high Kelly. The full Kelly fraction is 73%.
Awesome. So it doesn't even change much. So 77, 73, it's not going to have material.
Because P is so high here, right? So you're just taking 0.83 minus 0.17 divided by, right?
Exactly.
Yeah.
So typically, yeah, I mean, if your your P is high, the other component doesn't seem to matter too much, or at least it's not too sensitive to other factors.
You want both working for you, and one's going to work more than the other. And it could be the case that P is less than a half, and if your B is very high, it could still be a positive outcome. The next one's Nvidia. And I've done the same thing here. And I asked, this one is using Nvidia as the denominator because Bitcoin has outperformed, believe it or not, even though Nvidia grew exponentially for a decade at 68, 69%.
So again, wait a second. If you look at Nvidia's percent growth, I think like if you take a snapshot, it has grown more than Bitcoin lately, but this is like full history, right?
Right.
Okay, and so full history, Bitcoin still outperforms.
Correct. And for quite a few years, Nvidia was growing as an exponential single-digit percent. And then, then it just took off. And over this past decade, it's been 68, 69%. But the combination of those two goes to Bitcoin, because we know Bitcoin was really fast in the early years. And it's been consistent. And it's been high, even though it hasn't averaged 69% the last few years. So you'd still get 66% Bitcoin, annual rebalancing since 2011. Bitcoin won 9 years out of 13. And the ratio was huge. It was 9.8. When Bitcoin won, it won big. Mm-hmm. So you're basically subtracting a small number from 0.69 and you end up with 0.66. So if you just want to hold two assets, 2/3 Bitcoin, 1/3 Nvidia. Now that's what we call a full Kelly. That's the maximum risk that you would take. It optimizes your growth of wealth. It also skates a little closer to the edge, right? Because if you go above that, you're going to degrade your performance.
Okay. Now, let me add this wrinkle.
Yeah.
If maybe not in this case, but if I'm thinking I'm holding Bitcoin for like 10 years, then the chances of winning is reliably at like 100%. Mm-hmm. Maybe not. I don't know about Nvidia, but maybe if I'm looking at gold or dollar, it's like 100% likelihood of win. So in that case, it makes sense to not really diversify if your goal is for long run.
Well, Kelly is not a prediction about the future. Kelly is based on actual data in history.
Okay.
You're making an assumption that is not in the data, right? The data says you win 70% of the time.
All right. Sorry for interrupting. Go ahead.
Well, you the thing is, you're going to have years when you lose, right? So even during those 10 years, you're going to have lose. But so are you going to say? You could say, well, I'll look at the history of Bitcoin with a 10-year look back, and then you have 1.5 data points. That's not good statistics, right? Mm-hmm. There's an assumption here that you've got enough data points that P and B are well behaved, that they're roughly converging to some long-term behavior.
Got it. Like even if you look at 4-year, I don't think, I mean, I have to check, but Bitcoin has not been down over a 4-year period, but it just doesn't give you enough data that way to make a decisive decision.
Yeah, you'd have 4 data points. And you'll see when I look at at Mstr, I limit my time frame for exactly this reason.
Mm-hmm.
Okay, here we are, MicroStrategy. All right, we do mention the power law here again, just in passing, because it's different from the others. These others were all exponential assets. The difference here is that MicroStrategy is a leverage play on Bitcoin. And if you normalize back to the Genesis block, it has a relative behavior over the last 4 years of power law of the 1.36 power over and above Bitcoin. So if Bitcoin is growing at 5.7 power, then Mstr is growing at something like the 7th power of time, of which, the first almost 6 is due to Bitcoin, and the rest is due to the financial engineering and leverage. The question is, can it stay on that power law or not? But we're not going to assume that. We're just going to look at the historical performance to go into the Kelly criteria. It doesn't care whether it's a power law or something else. But now, MicroStrategy is the leveraged asset. Bitcoin is the thing we're denominating in. We're now inside the Bitcoin economy, right? And so what we do is we take the ratio of MicroStrategy to Bitcoin performance for each window. I've looked at monthly window and quarterly window. And the reason is that we've got 4 years of history since August 2020. And if I used annual, that would only be 4 data points. That's not enough to be forming statistics. Okay, and I'll give you the result, then I'll show you this actual spreadsheet for quarterly. What we find is that the optimal fraction in a 2-asset portfolio with Bitcoin and MicroStrategy is to put 30% into MicroStrategy if you do quarterly rebalancing, and to put 18% in if you do monthly rebalancing.
Okay, so quarterly, if you're thinking about rebalancing quarterly, 30% is optimal. If monthly, 18%.
Right. Okay, so here I have every quarter performance from Q3 2020. It was a partial quarter. It was a month and a half. Through Q4 2024, also a partial quarter, also a month and a half. So I just used, the result during that reduced quarter and just treated it equally. So how much did Mstr go up or down relative to Bitcoin? In the first quarter, it was down 9.5%, but then it was up by 54%. Then it was down by 39%, et cetera, et cetera. And the last quarter, the Q4 here it's good to within a few days. It doesn't have the last 3 or 4 days of Mstr and Bitcoin performance in it. And then we've just got up or down. Was MicroStrategy up or down relative? And then we count. So it was up 10 quarters. It was down 8 quarters. Okay. So 10 out of 18, P is 0.556, Q is 0.444. Mm-hmm. The sum of the total wins is 283%. The sum of the total losses is minus 130%. The average win is 28%. The average loss is 16%. That means that this ratio win to loss, B, is 1.75%. So to calculate F, we take 55% minus 44% divided by 1.75, and the answer is 30%.
Very good. Very good. Okay, so it wins with a slightly more chance, more than half, 55% of the time over Bitcoin. and then it underperforms the rest. But when it overperforms, it also does by quite some more. Win 2.8, average win 28%, average loss 16%.
It's kind of like saying it has a beta of 1.75, right? Okay, then the last number, G, I don't show the formula. It's a little bit longer, a little more complex, but you can calculate the expected gain per quarter going forward using those parameters, using B and F. Sorry, B, F, and P. Well, essentially B and F. And the average quarter going forward, you would expect to get 7.6% gain. And that's against Bitcoin. So it's very nice, right? That's measured in Bitcoin.
Wow. Okay. So the only challenge I have here is whether I want to rely on history or bring in some additional assumption about future. Both have their own advantages. Maybe in this case wouldn't really matter, but if, for example, if you're thinking that next year will be more like a bull market versus a bear market, it might actually change some of the ways you think about these numbers. But then it introduces extra assumptions, so and with risks.
Right, yeah. Now for monthly, the full Kelly was 18%. But actually, you can do quite well even with that allocation. You can make about 3% per month. So in that case, your equity curve is just as good as the quarterly case.
Okay, so more frequent rebalancing does not necessarily hurt you. Actually might slightly be better, but yeah. Okay.
Yeah. Okay, I wanted to show just for comparison, and this is this is now Bitcoin versus stocks, all stock. And this is not Kelly. This is if you use a more traditional technique of sharp maximization. And I just took this from portfoliovisualizer.com and just fed it Bitcoin and the Vanguard Total Stock Market ETF as the two assets. And this is data over 9 years, 2015 to, I think it was July or August of 2024. And it said, put 67% into the stock market and 1/3 into Bitcoin, which is interesting. It's allocating a lot to Bitcoin, but it's certainly not allocating the majority. And so it is leaving a lot on the table. And it's just the nature of the way, the Sharpe formula looks.
But they don't even follow this, right? I think Vanguard itself that you're looking here, they would probably say, oh, that 30% is pretty too high. Maybe they actually prefer 0 for a longer term.
They would show 0. I was just spoofing them by picking their ETF. Yeah. So this has nothing to do with Vanguard, except I picked it as the stock market. I could have picked SPY. Yeah. And this is a retirement portfolio. This was done with Portfolio Visualizer, but here I just put 70% into Bitcoin because I said, well, against cash, you want 70% Bitcoin. And instead of cash, I'll put it into the Vanguard fund. And I'll start with $1 million and I'll retire. And the question is, how much can I draw out? And it turns out, there's this rule of thumb, 4%, 5%, right? Annual withdrawals. So I set it to 4.5%. All the portfolios survive 30 years of withdrawal, at least for the way that they've projected future Bitcoin performance. Now, they don't know about the power law. They're just using history to somehow project the portfolio mix.
Yeah, a much better tool, as you said, is to use the Monte Carlo, but also add information about the potential growth rate of in the future using the power law model.
Right.
And I think for stock market, it's not a bad idea to use history because it's been much more mature and stable asset. But for Bitcoin, as because it's changing its nature so much, and one of the beautiful things of power law is that it gives us a base case for future instead of having to guess things.
Indeed. It gives us a comfort level about, where we are. It gives us confidence to go forward when times are not as good. And I think that aspect of it is just as important as, the future expected returns, is to have the confidence that it's not going to go to zero. And in fact, it's not going to fall by probably a factor of 2 based on the combination of the power law trend and volatility.
Exactly. And when you're in the bottom of the bear market, you would see that the power law suggested price is much, much higher. And you can look at that gap and see today's price might be, low, but the asset is undervalued relative to the historical performance. So that gives a very clear indication of how far down we are, and that this is not a like that the low number you see and you're so anxious about is not the fair value of the asset.
Right. And the Kelly formula would tell you in those, in those times to be adding to your Bitcoin position and selling down your cash position or your, Nvidia position or your gold position. So to summarize this, and I don't know how much, whether we have time or not, if you want to look at some of those equity
We don't have
curves.
limitation. We can go.
Okay. Well, let me summarize this, and then we'll look at a couple of the equity curve projections and histories. Basically, the summary is, I would say that 60-40 is obsolete. Bitcoin has made it obsolete. It's already been in a lot of trouble ever since the great financial crisis, as bond rates went to zero. And fortunately, Bitcoin came along at right that time. With Kelly, between Bitcoin and cash, you want to use long time frames, and that can give you comfort to have higher allocations and higher returns. If you're nervous about a full Kelly, well, you don't have to use a full Kelly. Some people like to use 2/3 Kelly or half Kelly. So you would take that 70 or 75% and multiply it by 1/2 or 2/3, your choice. So against cash or T-bills, you're in the 70 to 75% range. And if you're really risk averse, if you just put 5% into Bitcoin and 35% into T-bills, that's better than putting 40% into bonds. You don't need to hold bonds. And as we know, bonds.
That's so interesting.
Yeah.
So just cash or T-bills and Bitcoin, no bonds.
Right. I mean, bonds are just trying to give you a higher return than T-bills, right? That's what they're trying to do. And Bitcoin does that with a small allocation. Bitcoin and gold, annual rebalancing, you'd be at 77%. Nvidia, you'd be 66% Bitcoin against Nvidia. And with Mstr, it would not say to put a majority in Mstr. You should have less than half of your portfolio when compared to Bitcoin. And if you monthly rebalance, it would be down around the 18% level. Quarterly, it'd be around 30%. And then, we had that sharp comparison in the retirement thing. Thank you, Claude Shannon, John Kelly, Edward Thorpe, and my intern was ChatGPT. Let's look at some equity curves, though, in the appendix. These equity curves on this slide are for annual decisions. And I used a 5-year look back, which is a little more conservative on the blue line. And then I took all the data from 2011 with the orange line. And this is how your Bitcoin holdings would develop over time using the Kelly Criterion. And, each year you're recalculating the Kelly Criterion, changing and you're rebalancing at the same time. So you rebalance and update the latest Kelly criteria. And what you find is that if you only use the 5-year look back, your Bitcoin holdings would drop, but your equity curve is still very, very good. If you use and it's not surprising, right? Because you had such incredible return early on. If you use the full 14 years of data, then your amount of Bitcoin would not drop and your equity curve would be very steep. So you started here with $1,000 and you go up to $200,000. A $1,000 portfolio, even starting in 2016, would have grown to $200,000.
Yeah.
With optimal rebalancing. Incredible, right? And that's projection is, for 2025, it's just it's just ChatGPT did Monte Carlo projection for that.
I like how you skip all the boring stuff with ChatGPT. So
yeah. And this shows the equity curves, and this is for the question you were asking: the weekly equity curve, the 4-week, the quarterly, and the 52-week. So here I started in 2018, and I took it out to trying to think when I did this. I did this a few months ago. Why that one goes to 2025, I'm not sure, but into 2024.
Mm-hmm.
And you started out with 1,000 with the weekly criteria. You grew to 1,800. It wasn't phenomenal. With the monthly criteria, 4-week, you grew your $1,000 to 2,700. With quarterly decisions, you grew it to 6,300. And with annual decisions, you grew it from 1,000 to 11,000.
Wow. So tweaking less is better. Trading actually makes it worse.
Be chill.
And I can see the logic here, because Bitcoin, just if you don't touch it, it does so well that it gives you much more likelihood of success. But if you trade all the time, every time you have to make a bet that could go wrong. But if you don't do those short bets and just wait for a long time, the chances of winning just goes up. It might go down a couple weeks, but on average, because it goes up, your likelihood of success approaches 100% if you hold longer. So it's kind of like it turns a lot of small bets with fair success rate into a one huge bet with a super high success rate.
Correct. That's it. I think that's the lesson here. You can have very significant allocations, but you need to use those longer time frames of quarterly or annual for rebalancing.
Exactly. And if you looked at a tweet I posted last night, my personal approach was that, well, everyone wants to accumulate more. So when you get into Bitcoin, it goes up fast. and a lot of people try to push you to join this other coin or this other solution that will outperform Bitcoin. But my thinking was that why do I add risk? Why do I add something that I don't know? Bitcoin is trustworthy, reliable. Why would you go with an unknown thing that might outperform or not? So instead, I said, I have a lot of conviction in this thing. So if I want to really make a significant amount of success, I'll just maximize the amount. So I bumped it up to 100%.
Mm-hmm.
And it gave me rapid growth plus minimal risk. I don't care about anything in the world. My Bitcoin is not gonna get destroyed. So, but if you have like another coin that's controlled by a bunch of developers or company, you have to constantly follow the news and events. And if you really do your job well, maybe you guess it right, and then nothing bad happens to them. It's just a risk that I'm not willing to take, but I'm willing to go up to 100% in Bitcoin.
Mm-hmm. Two comments. First, I have the one sentence summary of that, which is Bitcoin gives me all the return I need and all the risk I need. And I want risk. I want volatility, right? Because that's what drives the return. The second comment is there are different variants of the Kelly formula. And if you use the variant that looks a little bit more like a Sharpe formula, it takes a mean return minus a risk-free rate and divides by a standard deviation, sounds like a Sharpe, right? Then it actually gets you at 100% and above.
Uh-huh.
And that's because this Kelly formula assumes the possibility of total loss in a given time interval. But we never have a 100% loss in a given time interval, right? We have a maximum loss of, in a year, 60, 70%. So it then becomes a question of how much volatility can you live with? And it becomes your psychology, right? Around that.
Yeah. Yeah. So basically, what you're saying is if you add some more information about the likelihood, so essentially, if you say 100 loss is not likely, then Kelly would allow you to even add more aggressiveness. And yeah, and go higher in the ratio. So that makes sense too. That makes sense. So if you have, let's go back to the MicroStrategy and Bitcoin combination. So if you have a portfolio fully Bitcoin, now you want to add some spice through MicroStrategy, and you showed us different percentages. Practically speaking, if someone's listening to this and still considering, okay, I want to enter MicroStrategy and so on, what can I learn from this? By the way, not financial advice. This is just for educational purposes. But if someone wants to learn from this and add some spice, because MicroStrategy might outperform Bitcoin next year because all the positive things that's happening for it and so on, how would you think about this? Would you use the output of Kelly itself, or how would you even think about the rebalancing? What time window is better? How would you think about full Kelly versus a partial Kelly? How would you think about which formula which variant of Kelly to use? What would be your own thinking?
Right. Well, I would say using a variant is probably not necessary. I think the simple formula is sufficient. And what I like about it is people can do it themselves in a spreadsheet. I showed you how to do it, and people should do it themselves. And I would suggest for somebody that is starting out with Kelly and thinking about doing this, given that the expected returns were similar, that they would maybe take the monthly approach. And that means for now, they could allocate up to 18%. And they should rebalance monthly so that if, Mstr goes up substantially more than Bitcoin, and a month and a half from now, or I should say 2 months from now, the portfolio looks like it has 25% in Mstr, then they would sell some of that and put it back into Bitcoin, right? And they can decide for themselves how much risk they want to take. Do they want the full Kelly at 18% or half a Kelly at 9 or 10%? I think personally, I'm somewhere in that range. I'm not quite at that full Kelly, but the way Mstr's going, I probably will be very soon.
Yeah. So basically, and the good thing about this portfolio is it combines two assets that are essentially benefiting from the same fundamentals, and both should go up together. Except MicroStrategy adds some more volatility because of the MNAV multiplier that might come from what happens in the fiat markets and excitement that might be generated there. So it's like on average, both of them actually follow the same trajectory. If Bitcoin goes up, your MicroStrategy goes up. But in some cases, there's so much enthusiasm around this stock that might outperform, and that's probably a good place to rebalance because MicroStrategy at the end of the day is anchored to Bitcoin.
Yeah, we'll have that discussion another day, but it's an incredible financial engine that he's constructed.
Yeah, I'd love to actually discuss that as well. Get your take on it, on that whole the way to think about MicroStrategy and MNAV. We've had some discussions about your thinking of how it works, but essentially the wonderful thing about Kelly Criterion, I think, is it takes away the guesswork, and you don't necessarily have to like go create a whole philosophy and spend years studying an asset. If you have a general understanding of what's going on, Kelly allows you to benefit from volatility, and it kind of saves a lot of time, I guess. Yeah, very interesting. Thanks a lot. So let's summarize. Kelly Criterion allows us to figure out how to construct a portfolio and optimize it for maximizing log of wealth. And its advantages are that it protects against losses, protects you against ruin as well in one variant at least. And you can use that, and with a simple calculation in a spreadsheet, you can use that to understand what is the right allocation to something that's more volatile than your base investment. For example, if you're looking at Bitcoin versus cash or T-bills, that would put you at something about 75% Bitcoin, the rest cash. Or if you're thinking about MicroStrategy, it might suggest, for example, on a monthly rebalancing basis, 18% of your portfolio should be in MicroStrategy to benefit most from the combined portfolio, and so on. So this is a very common question. People are asking me, how much to allocate to what. So now we have a tool that allows you to avoid the guesswork and let the math do the work for you.
Excellent summary. Yes.
Thank you very much, Stephen. Absolutely useful alpha here. This should be a wonderful education to so many people, and I look forward to hearing everyone's feedback. If you want to try this, maybe do it and post on Twitter and tag Stephen, and definitely follow Stephen Money or Debt on YouTube, Twitter. He puts out fantastic content. Whenever he puts out a tweet, my thinking is this is a very well thought out tweet. So what he says, like in every sentence, careful thinking, lots of brilliance is in there. I read very carefully whatever he has to say. So definitely one of the most one of the absolute must follows on Bitcoin Twitter, and we'll keep learning from him.
Thanks so much. It's been a pleasure.
Thank you very much. Goodbye, everyone.